Hello, my name is Neeta Patel. My husband and I run a company called Lakshmi Capital. Our goal is to buy, fix, and rent properties. My role is to handle the day-to-day operations, conduct market research, and identify new projects in which to invest. I began my career with an undergraduate in mathematics, and my first job was in accounting. But I soon became frustrated and wanted to find a way to express my creativity without being stuck behind a desk. My second career was in public relations, where I worked with tech companies to help them develop and promote products and services to their customers. I was very successful, but again, eventually became frustrated when I felt I wasn't learning as much. So I took a break and went back to university to do my MBA, or Master's in Business Administration. After that, I was hired by a company called Duke Energy, where I ran strategic planning for them. The company challenged me to grow and master a number of different jobs, the most exciting of which was the development and piloting of clean energy technologies. Well, I guess my work got noticed. I was recruited by a company called Pratt & Whitney Rocketdyne, who developed rocket engines for spacecraft such as the shuttle and SLS, or Space Launch Systems. That's the vehicle that will be used for human exploration beyond Earth's orbit to the moon and to Mars. It was a really exciting place to work, and I got to work with some brilliant rocket scientists to develop clean energy technologies for use right here on Earth. I've enjoyed a fun and challenging career, and throughout it, I've always believed in living modestly and saving aggressively. By saving as much as I could, I was able to pay off my student loan and my home mortgage loan more quickly than others. Then I began to buy houses and commercial buildings to rent out. That strategy accelerated when I married and my husband enjoyed saving as much as I did. 3 years ago, the income from our properties exceeded the money we made from our corporate jobs, so we were able to retire. We now enjoy financial freedom and spend our time continuing to grow our portfolio and, more importantly, do the things we love to do. Saving has been a very important part of my success, and that is why I have chosen to talk to you about this topic. I'm going to review a few key concepts with you to help you as you begin your own savings journey. The first concept I want to talk about is pay yourself first. This is where you automatically save a specified amount from your paycheck before you can accidentally spend it on things you may not really need. Let's say your employer pays you $4,000 a month. The idea of paying yourself means that you take the first 10%, say, or in this case $400, and you set it aside immediately for your savings or for future investment. That ensures you can't spend it on other things. After you've paid yourself, you'll have to pay for essentials such as your rent, food to feed you, a car to take you to work, and gas, of course, and other things like insurance and tax. After that, you may choose to treat yourself, perhaps a trip to the movies, a nice dinner out, or a new jacket. And you can do all of that happily and without guilt, knowing that you have already paid yourself first and set money aside for your savings. A savings account is an interest-bearing account where people put money away for future use. Money experts tell us that a good rule of thumb is to save 10 to 20% of any money we receive. When you pay yourself first, you automatically save a portion of your paycheck for future use and deposit it straight into your savings account. It's a good idea to set yourself a savings goal and have a plan for how you want to use it. When you first begin saving, I recommend trying to put away enough money to cover your typical living expenses for at least 3 to 6 months. I call this my emergency fund, and it comes in really handy for unexpected things, like temporarily losing your job or having to repair a car after an accident. After that, you can start to save for other things, perhaps a vacation, a new computer, a new car, or even a deposit for a new home. Knowing what it's going to be used for will help you stay motivated and disciplined and stick to your savings plan. When you open a savings account, many banks offer interest, which means they will pay you a small fee for the privilege of using your money. Interest is calculated as a percentage of the principal or balance. The amount is usually quoted as an annual rate, but interest can be calculated for periods that are both longer or shorter than 1 year. Simple interest is interest that is paid only on the original amount. For example, let's say Peter saves $10,000 and decides to open a savings account at a bank that offers an interest rate of 1% a year. At the end of the first year, the bank will pay Peter 1% of the principal, which in this case is $10,000. So the interest earned at the end of year 1 is $100, and the new balance will be $10,100. If Peter does not add any more savings, but leaves the money in the account, he will again earn 1% or $100, and so on for every year that he leaves the money in the bank account. By the end of 10 years, he will still have his original $10,000 in the bank, but he will have also earned $100 per year, or $1,000 in total for the 10 years, so his new balance will be $11,000, and he would have gained a total of $1,000 in interest. Compound interest is interest earned on the principal and the accumulated interest. So let's look at our example again, where Peter deposits $10,000 in a savings account with an interest rate of 1% per year. At the end of the first year, the bank pays Peter 1% of the principal, which equates to $100. In the second year, however, the bank will pay interest on $10,000, the principal, plus $100, the interest so far. So the interest payment for the second year will be 1% of $10,100, which is $101. So now the balance becomes $10,201. In the third year, the interest payment will be 1% of $10,201, which equates to $102. So now the balance is $10,303. By the end of 10 years, the balance will be $11,046.22, compared to just $11,000 in the case of simple interest. And Peter will have gained a total interest of $1,046.22. As you can see, compound interest requires time and the reinvestment of earnings. By giving investments more time to grow, the accumulation of interest on the interest itself can dramatically increase a savings or investment account. I want you to keep in mind that in the examples we showed earlier, we did not grow the principal. In reality, however, I hope that you continue to add to your savings account every month so that the balance continues to grow and the interest grows along with it, much faster than in the examples we showed. As your savings level increases, you will discover new investment opportunities that yield a better return than your typical bank savings account. For example, stocks, bonds, or real estate. Just keep in mind that every investment offers different levels of income or rates of return, and they also carry different levels of risk. You should always educate yourself and, if necessary, seek advice before making investment decisions. When it comes to a saving strategy, there are two key decisions you need to make. First, how much of your income you will save, and second, how long will you save for? In other words, when will you begin to save? Let's take a look at this example. Peter makes $50,000 annually. Let's see what happens over time when Peter saves just 10% of his income and is able to invest it where he can earn 5% compounded annually. If he starts to save very late in life and is only able to save for 10 years before retirement, he will have saved only $61,250 for retirement. But if he begins saving as soon as he gets his first job and is able to resist dipping into his savings for 40 years, he will have saved $395,000 for his retirement. And during that 40 years, he will have only deposited 10% or $5,000 per year for a total of $200,000. But he's made his money work for him and earned an additional $195,000, almost doubling his money without doing anything extra. Now let's look at what happens over time if Peter can save 20% of his income. If he only saves for 10 years, he will have saved $122,500. But if he has the discipline to save for his entire 40-year career, he will have turned $400,000 of deposits into $790,000 without doing any additional work. Again, nearly doubling his savings. That's a very nice little nest egg for retirement. And what a difference the extra years of savings make. So the lesson here is that how much you save and how long you save for can really have a massive multiplying effect on your money. The earlier you start and the more you save, the better off you will be. Before I wrap up, I just want to give you an idea of how much power you really hold yourself in terms of building your wealth. Let's say you get your first job ever and it pays $50,000 annually. That's a little less than the national average for a college graduate. Now let's say you hold that job for 40 years. That's a typical career length. More than $2 million will pass through your hands in your career, and it could be even more when you factor in pay raises, promotions, bonuses, and the opportunity to make your money grow through interest. So you're already a millionaire. My challenge to you is to think about how you will use your fortune. Will you put it to good use, or will you allow yourself to waste it on things you really don't need? That choice is entirely yours. I hope you have enjoyed this lesson and are motivated to start saving. How much can you save, and what will you do with it?